Hello everyone, welcome to today's US Open live webinar. It is Thursday, July the 13th, 10 minutes before Wall Street opens. I'm your host, Nikos Zabouras, Senior Market Specialist at FXCM. So yesterday, Wednesday, was the most intense day of a very busy week with US CPI being released and showing significant moderation. And this was also confirmed by today's PPI, Producer Price Index. And of course, yesterday we also got two policy decisions by the Reserve Bank of New Zealand and the Bank of Canada. That's what we will be talking about today. As always, though, before we begin, please read carefully through the risk warnings and the disclaimers. Please note that anything discussed here does not constitute investment advice and should not be construed as such. Okay, let's get the ball rolling. Quite a few things to talk about today. Let's start with the CPI report from yesterday, the inflation report, which showed a significant deceleration in both core and headline figures, sending the US dollar lower and Wall Street to new 2023 highs. Markets still expect a 25 basis points hike later this month and still view 5.5% as the terminal rate. What changed, though, is that investors now seem to turn their focus to the timing and extent of rate cuts. They seem to be shifting away from the conversation of hikes and are moving into cuts. CME's Fed would stool prices in such an outcome as early as January at this point. Now, as a result, Euro USD jumped to the highest level in more than a year, trying to take out 1.1233, as you can see here on our screen, although we are still a bit cautious for further gains towards 1.1495. From a technical perspective, the move is overextended and a pullback towards 1.1032, the former resistance now turned support, would definitely be reasonable. The downside, however, is well protected, with especially from the 200 period EMA at around 1.09. Furthermore, the Fed has been quite aggressive as the labor market remains tight despite some signs of cooling, while the economy performs better than expected. So for the Fed to stop hiking, let alone start cutting rates, it means that this disinflation, immaculate disinflation scenario would materialize, and anything we know from the Phillips curve would be thrown out of the window. Of course, these are extraordinary times because we're seeing things that in the pandemic and post-pandemic era that we hadn't seen before. Now that's it for Euro USD. Now let's turn to the Kiwi, the New Zealand dollar. The Reserve Bank of New Zealand has been at the forefront of monetary tightening, having delivered 525 basis points of hikes since the October 2021 liftoff. The economy, however, entered a technical recession, two negative quarters, and the bank expects two more to come of negative growth. So policymakers held rates steady in a watershed moment. It was not a surprise, though, since May's projection had pointed to the current 5.5% rate as the terminal one. Remains to be seen if policymakers can stay on the sidelines at the time when some of their major counterparts are forced to restart or reaccelerate their hiking cycles. NZD/USD had a bit of a mixed reaction initially, but then came the US CPI report and the pair rallied due to the greenback's hardships. This brings the 2023 highs in the spotlight, 0.6539, but we're not yet convinced that this can be cleared. The RBNZ did not show inclination to hike again, while the Fed's projections imply 2 more increases. Overbought conditions could put pressure towards 0.624, 0.625, but strong catalyst would be needed for further corrections that could test the 200-period EMA, which sits currently at around 0.612. 617, sorry. And now let's move to Wall Street, to the NAS 100. The driver here is, of course, US CPI and today's PPI that corroborates this disinflation story. It will be interesting to see if Chair Powell reinstates this wording, disinflation, which he had used back in February, but this proved premature back then and quickly retracted it. But in any case, the tech-heavy index rallies, and there's a broader risk on mood right now. It sets new 2023 highs and breaks the 16 and comes closer to the 16K mark, although fresh impetus will be required for taking it out. Markets have been wrong before, however, around the Fed, and the pullback is definitely something that we could see, although a significant change in sentiment would be required for the 200-period EMAs to be challenged at around 14,773 currently. And of course, earnings are a risk factor, either positive or negative, depending on the outcome. So let's see what lies ahead, and also touch a bit on the Bank of Canada. One is any comments from Fed officials that will be looking. There are some scheduled speeches this week, right before the communication blackout period kicks in, ahead of the July 26th decision. Sorry. Now, we already had Delta Airlines out with record revenues earlier today, boosted by strong consumer demand and lower and also positive impact from lower fuel costs on its bottom line. Now, big banks are in the spotlight. JP Morgan, Citi, and others report tomorrow. And of course, next week, Tesla and Netflix take center stage. Stay tuned for more coverage before the earnings and after them. Now, moving on to next week, it starts strong with a data dump from China due to GDP, industrial production, and retail sales on Monday, while on Tuesday you expect US retail sales and Canada CPI inflation. The Bank of Canada raised rates yesterday for second straight time since it restarted its hiking cycle last month in order to control inflation. The statement said that the governing council remains concerned that progress towards the 2% target could stall, jeopardizing the return to price stability. So the inflation data next Tuesday will definitely be crucial. That's it from me for today. We will talk again next week on Tuesday, 10 minutes before Wall Street opens. Thank you for joining me.